Hi, and welcome to another video from the Matchmaker Group. My name is Myles. To my left, I have Paul Lewis.
Hello.
To my right, I have Simon Dalgleish.
Hello.
So we've called this video together because we wanted to talk about something that's really pressing with everybody who has a mortgage, and that's in relation to the timeline of paying off that mortgage. So Simon, you're talking about some pretty scary stats the other day.
Yeah, we've got some interesting details that have come through. In the last 3 decades, we've actually seen a 600% increase in the number of people that are aged 55 or more that are actually retiring with a mortgage. And they're asking us, well, how do we get out of this?
Sure. So retiring with debt is not a situation people want to be in. So Paul Lewis from My Mortgage Minimiser will have a chat about what can be done in relation to that.
Sure. My Mortgage Minimiser came about by myself and my business partner John. We've been working in finance since the late 80s, and we've seen a hell of a lot of change over those decades. And one fundamental change we have seen, as Simon talked about, was the enormous increase in debt, in home loan debt, and the enormous increase in people coming to us through our financial planning channel who are in their early 50s, even late 50s, with home loan debt.
Yeah.
Also with investment debt as well, against investment properties, because they were, encouraged and taught, don't pay your debt off, don't pay your investment debt off, it's tax deductible, etc.
Well, they keep on thinking that their super's actually going to cover it.
Correct.
But in many cases, I'm seeing that there's not enough in superannuation as a exit strategy to pay out their mortgage and still give them a lifestyle to lead.
100%, absolutely. And look, we've seen clients who have superannuation, maybe enough to clear their home loan debt, maybe a little bit extra, but you can't live for an extra 20 or 30 years on 150 grand worth of super. You have to pay your debt off. Now, we're in a very unique situation in the last 10 years since the GFC. What we've seen since the GFC is interest rates on lending just continually drop. We're down to 0.25% official cash rate. We are rock bottom on interest rates. Yet investment markets have grown. They fell through the GFC, but they recovered within about 6 or 7 years after GFC, full 100% recovery. People's superannuation, people's investments, etc., and growth since then. So we've seen investment markets grow. We've seen income grow a little bit. We haven't seen a huge amount of inflation or wage growth, but we have seen some. So in relative terms, people today who are working full-time, part-time, what have you, and have an income, in relative terms are probably slightly better off than they were prior to GFC. Yet they're electing to pay 2.5, 3% on their home loan. Why would you do that when prior to GFC, interest rates were 7, 8%. Long-term average interest rates in Australia are 6.5%. Why choose to pay 2.5% when you've got the financial means, you've got the economy to be able to pay a higher?
It's interesting that you mention about that 6.5% as being the average over the years, because the banks tend to use a higher interest rate to work out how much money you can borrow should interest rates increase. Because let's face it, if you've got a debt sentence of 30 years on your mortgage, you've got to expect that the interest rates that we've got today at some time are going to increase. So
100%.
If you're spending the money that you are now actually saving, how are you going to adjust your lifestyle to actually count for when rates do increase?
And look, it's interesting.
Wow,
debt sentence is big business. It's big business for the banks. The banks want you in debt forever. And they're very, very clever in the way they've done that. Over the last 20 years particularly, they've done that by portraying their home loans as some kind of an amazing product. Offset accounts and redraw, and you can do all these wonderful things. At the end of the day, a debt is a debt. It's money that you owe. Now, when we're talking about making payments at 6.5%, we're not talking about taking a loan at 6.5% when they're currently 3%. Okay? That's just stupid.
Not a strategy we suggest.
What we're talking about is the mindset that the payments that you pay to your debt really should be based on the long-term average. And what would happen if you were paying your home loan or your investment loan, whichever one or both, assuming a long-term average interest rate of 6.5%, but you're actually getting the 2.5%, 3%, then you've cut your debt in half.
So what are you suggesting that they actually do with that difference between what they should be paying at around that 6.5% and what they're actually paying at that 2.5%,
Yeah,
3%, depending on whether it's variable or fixed rate that they're paying.
Yeah, interesting question. The way the program's designed, we do things a little bit differently. Now, at the end of the day, you could elect to pay some more off your loan and just pump it in there. Yep. The problem is, it doesn't work. And it doesn't work because your loan is in your face all the time.
You're sitting it in a redraw, you can see it on your bank account when it's right
exactly
there.
Right there. Yep. Exactly. And that's how the banks get you into debt and keep you into debt forever. They're very, very clever. They've made your home loan, investment loan, any lending, part of your day-to-day transactional banking. So every time you're on, it's there. Now, if you've made extra payments on your home loan, you have a look at your screen and you'll see that extra as $5,000, $3,000, whatever early gains you've made, CR, credit. Wow, that's cash. That's my cash.
That's my holiday. That's my new TV.
I can go spend it. Now, and the very cunning thing about this is that really trivialises your early gains that you make on your loan. So any investment or any debt reduction has to start somewhere. Yep. Okay, it's kind of like if you're out there growing a crop, you've got to sow the seeds, and the little seedlings come up. Right? They're not worth much. They're not the plants you want yet. And does it really matter if you just pick it? Yeah. Juicy little seedling. You just plant another one. Right? Look, it's only $2,000. It's only $3,000. I can make that up in the next couple of months. That's not going to make any difference.
But if you keep doing that time and time again, 10 years down the track,
correct,
you've got no crop.
You've got no crop.
100%.
You're not ahead at all.
Exactly right. Yeah. And the other very, very cunning marketing tool that they use is refinancing.
Yeah,
it's huge. Trying to make people focus on, this is a much better home loan. This is a great home loan. It's a great new product. It's got a fantastic interest rate. We can save you thousands if you come over here and you move your home loan to this new provider over here. Now, you'll be shown maths and you'll be shown figures to say, oh my God, I can save $20,000. You go through it all, you feel great.
And that's huge at the moment because some banks are actually offering a cash incentive
100%.
to come across.
They're buying business.
What we see most of the banks and other brokers, institutions doing is that they're resetting that home loan for another 30 years.
100%.
So if you start off with a 30-year loan,
it's crazy.
The average Australian will look at refinancing their home every 3.9 years.
Yep.
So I suppose using the term debt sentence probably really is true because you've taken out a 30-year loan that then becomes 33.9 years and so on and so forth that you end up with a 40, 50-year home loan, not 30 years.
And the rest, and I'll throw this out to the viewers here watching this video. How many of you have had your home for more than 10 years or your home loan for more than 10 years, 5 years, 10 years, 15 years? How much did you borrow for the home in the first place or the investment property? How much do you owe today? How long have you been paying that off for? You ask those questions and it's very sobering. All of a sudden you're sitting there going, I haven't got anywhere.
Yeah.
Why have you got anywhere? Because that's how they've designed lending.
And the banks have spent a lot of money and they're very smart in doing that and in trapping people into a system that makes that bank a lot more money.
100%. It's very psychological.
So you're turning it on its head.
Exactly right. So what we've done with our program, there are a few simple rules that we put in place straight away. Rule number one, your home loan is a debt.
Yep.
It's nothing more. It's not a product. It doesn't have a name. We don't care about offset accounts. We don't care about redraw. We don't care about any of that stuff. It's money you owe the bank. So number one, your home loan is away from your transactional account. Wherever your transactional personal banking is, keep it there.
Yep.
Keep your day-to-day banking there. Your home loan
saves them losing where their direct debits are and changing from one bank to the next.
100%.
All that inconvenience and time and potentially in that transition, they could actually miss making a payment on something important as life insurance, if they've got it outside of super, or health insurance, or as one client had, they didn't realise they were driving their car around because their monthly direct debits didn't come out.
And look, frankly, it's a pain in the ass.
Yeah.
Getting your all your banking transferred to somewhere else just because your home loan goes there, that's crazy. The bottom line is it doesn't matter where your home loan is. And what we do is we actually encourage you not to register for internet banking or for it's over here, out of mind,
out of sight.
Out of sight.
Yeah.
The second thing we do is we work with our clients to work out, well, how much do you want to pay for your home? Not how much the bank tells you what your minimum payment is, because don't forget, the banks are going to tell you, you pay this much money. That's what it is. That's your debt sentence. If you let the banks dictate your terms, then you'll never get out of debt, because that's what they do. They keep you in debt.
Yep.
So you ignore that, and you have a look at your own budgeting. You have a look at your own financials. You go, you know what? I choose to pay this much money per month. That then dictates your loan term. So you're now in charge. So that's what we do. Now, what we aim for is for that repayment to be based on the long-term average of 6.5. Now, if you can get that, brilliant. You'll chop your loan in half. If you can do more than that, even better. If you can't quite make it, that's okay as well. Now, what there'll be a differential between the minimum contractual payment on the loan and what you want to pay, what you're willing to pay onto there. Now, we also take that off the table, out of mind, out of sight, and we pop it over here in an external investment. And we do that. We don't pay it on the home loan because, again, the whole point of redraw, instant. Even if you haven't registered for internet banking and you want money quickly,
you'll know
you'll
you're
get
accruing it. You'll see it there. You'll take the seedling and
Now, that doesn't mean that you can't get the money that you put externally over here, but it is more of a process to get it. It takes about 10 days. So it eliminates just seeing
the TV specials.
Yeah, correct. Exactly right. And
to use Myles' term from
exactly
before.
right. So what it does is we basically take this money and it hits their account. They get paid, gone. Home loan, investment over here. Now the investment, we won't get into that today, but ultimately, if you think about it in simple terms, it's a managed fund investment, pretty much the same as your industry super fund. All right, so if you've got an Australian super fund or a HESTA or whatever, and you haven't really done anything with it, what you've got is a balanced managed fund.
And it's a long term.
It's a long term. Now, your balanced managed fund can sit within superannuation or can sit outside of superannuation. That's just the platform that it sits in. So this sits outside of superannuation because we don't want to preserve.
It's a program that is tailored to the individual's circumstances and what they want to achieve. And has them in control as opposed to the bank.
Absolutely, 100%. And basically, as I said, we've got a very brilliant scenario in terms of interest rates and market at the moment. We've got interest rates on owner-occupied loans as little as 2.09% for a 3-year fixed. Okay,
the lowest they've ever been and will ever be.
Exactly right. And at the end of the day, you can take advantage of those fixed rates and still accelerate your loan repayment. So you get the best of both worlds. Bottom line is, it's a simple program in design. It's a simple program in execution, and it is absolutely effective. Absolutely 100% effective.
Great. Well, I think it is a bit of a wrap up now. If you have a home loan and you would like to reduce the term of that and put the power back in your hands rather than into the banks, please contact us for more information. Like, subscribe, hit on the links below. Thank you, and we'll see you in the next video.